Credit cycles refer to the recurring pattern of expansion and contraction in credit availability and pricing within an economy. They are characterized by shifts in lending standards, in credit demand, and in overall market conditions. They typically consist of 4 phases: the downturn, the credit repair, the recovery, and the expansion to late cycle phase. Central banks play a key role in controlling credit cycles through interest rate adjustments, while financial institutions act as a transmission channel in creating or restricting credit. Both have thus a large impact on borrowing costs, which is an essential parameter for business and household investment decisions, and therefore for the overall economy. Several indicators are suggesting that the US credit cycle is in its expansion to late cycle phase, namely a strong, albeit moderating economic growth, a persistent inflation, which would force the Fed to maintain its restrictive policy for longer, and a sustained credit growth, except maybe for certain sectors, such as commercial real estate. Another point is the deterioration in corporate balance sheets over recent quarters, reflected by the rise of leverage and the decline in solvency ratios due to higher borrowing costs. Finally, another symptom is the rich valuation observed in risky assets, as evidenced by credit spreads currently flirting with their historical lows and indicating a certain degree of complacency from investors. Corporate fundamentals have improved sharply in the aftermath of the pandemic, benefiting from the strong economic recovery. Along with an abundant liquidity in markets and a sustained risk appetite, this has attracted investors back to the corporate bond market. But the decisive factor has been obviously the rise in yields resulting from the Fed's monetary tightening. Indeed, US investment-grade corporate bonds are now trading at an average yield of 5.7%, a level not observed since 2009. While the Fed seems to have succeeded in achieving a soft landing in the current tightening cycle, risks for a harder landing remain, the most significant being a persistent inflation. What is certain for now is that the Fed's room to maneuver is shrinking, and that it's preparing markets for higher for longer rates, which will probably continue to generate volatility in rate and credit markets. In the context of a maturing credit cycle, current levels of spread look relatively complacent and advocate for a cautious and selective approach in corporate bond markets. For fixed income portfolios, this translates in a reduction of credit risk in favor of high-quality investment-grade bonds and treasuries. In terms of duration, short maturities represent a sweet spot for now, considering the inversion of sovereign and corporate yield curves, and given the volatility on markets stemming from uncertainties over the timing of the next easing cycle.